Welcome back. You're watching the 80 Money Show with me, Kavita Thapliyal. Now, mutual funds are subjected to market risk. Please read all scheme documents carefully. Now, this is the health warning that viewers, you and I receive before buying mutual funds. But what about the advice and recommendations coming from brokers and agents and distributors? While they try their best to sweet talk you into buying mutual funds, as an investor, you should be careful in taking everything that they say with a pinch of salt. On the 80 Money Show today, we will tell you things you shouldn't believe when a broker or agent or distributor recommends when buying a mutual fund. Now, for this, let's bring on board Gautam Kalia, Senior VP and Head Super Investor Share Khan by BNP Paribas, and Amit Kukreja, founder Amit Kukreja Advisory. Welcome, both of you. Gautam, first question to you. How often do you think agents, brokers, and distributors, when selling mutual funds, they try to sweet talk investors and try to project a figure or maybe returns which are actually unreal?
So I think it doesn't happen that often.
Okay.
I don't see this as something being rampant in the industry. I think most people are well-meaning when they enter this business on our side, and they are well-meaning when they are interacting with clients. It's just that maybe there are different pressures and they react differently to it, and they don't articulate the risks clearly. And I think that's really the problem. One is obviously misselling and misleading the client entirely. I think the other problem, which I think is more rampant, is really not articulating all the risks that the client can experience. Because if you give a fair idea of the risk to the client, then you'll see that you have a much more longer lasting productive relationship with the client. And I think that people don't really understand, that maturity is not there enough uh, uh, still in some pockets. And once that comes in, then I don't think clients need to worry that much.
As compared to insurance, I mean, mutual funds, they have few cases of mis-selling, definitely. But then a lot also can be, blamed, or not exactly blamed, but then spoken about to the investor who are not well-read and they don't know about the investment product that they put their money in. But as you rightly said, that a lot of time the risk is not articulated. So, Amit, the question to you will be, what are the red flags that one should catch when talking to a broker, distributor, or an agent while buying a mutual fund?
Sure, Kavita. So two things. One, obviously, the person who's buying a product, his awareness plays a very important role. And the person who's selling the product, what is he trying to achieve by selling the product? So if you look at what is he trying to achieve by selling the product, if he's gunning for a high number of volumes of product sales, obviously his interest is not aligned to the person who is buying the product, right? Because the person who is buying the product is buying for a particular financial goal, and he wants to use his money by investing in that product to achieve that goal for faster. So in my opinion, the red flags are, if the person who's selling the product is not articulating the risk, as Gautam was saying, is not quantifying or saying that this investment is subject to market risk, if he's using the word like guaranteed returns, if he's using the word like absolutely free from volatility, if he's using the word like it's always tax efficient irrespective of the holding period, if he's using the word like it's a best performing fund ever since it started, or it's from a best performing fund house ever since they started, these are certain words that you should always take with a pinch of salt. Best performing, always, no risk, guaranteed returns, no volatility, and always beating FD returns. So we have to understand from a buyer's point of view that a market-based product has its own volatility, has its own standard deviation, has its own variation in the returns as the markets go through different cycles. So person has to be cognizant of these points, in my opinion.
Gautam, do you have a list of red flags too?
Yeah, so
Sure.
most of them are covered, but I've seen in some situations where the person on our side will say something like a personal guarantee. that
Yeah,
trust me, I have invested, so you take
exactly.
my guarantee for it. So
But
I
don't you
think
think that gets
personal.
us closer to the person who's selling the product? I mean, it makes us easy to believe that person if someone says that I have put my money into this, see, and I've got this kind of return so many years. No?
Yes, absolutely. So, if it does bring you closer, but as long as you don't take the personal guarantee aspect seriously, because that's really where the problem is. I invest all my savings in mutual funds and I share that experience with my clients all the time. But it's about providing some sort of personal guarantee because you're not really getting into a legal agreement with that individual where that individual is going to make good a certain loss. And it may be said with the best of intentions, but that is clearly wrong and that is misleading. I think the ideal scenario is where you are painting a more accurate picture for the client, allowing the client to understand that his 100 rupees invested can go down to 70, 60. There have been times, situations in the market where people have lost even 70, 80% of their principal. Obviously they have stayed invested and recouped that, and that very important to share both the negative and the positive of these things. I think that's really where the picture is, that we many places the balanced view is not really expressed. The second thing is where people, let's say that it's a guaranteed principle, that your principal is capital protected, or I think that is again something, that a phrase that people need to keep in mind, that when it is subject to market risk, then while there are products that are capital guaranteed, but these are not. So that needs to be clarified.
All right. So, a couple of things that I think in the course of our discussion we'll be discussing more. But then let's quickly move on to our viewer queries because we need to answer these questions. So, Gautam, the first question is for you from Sapna. She says that she is 20 years old and she's investing in mutual funds since last year only and investing almost 10,000 per month. And the portfolio detail says that she has HDFC mid cap opportunity, HDFC flexi cap, SBI small cap, and she wants a corpus of around 1 crore in 15 years. She wants to know if the fund selection needs any sort of change.
Right. So my answers to Sapna here, Sapna, you'll probably need to increase your SIP to about 20,000 to be able to achieve your target. And I'll just tell you what schemes you should invest in. SBI small cap fund you should continue, which you already have. HDFC flexi cap fund you should continue. HDFC mid cap opportunities fund you should replace because now you got too much AMC level exposure. So I'm going to give you de-risk you from concentration in a particular AMC. So that money you can move to Kotak Emerging Equity Fund. It will be in the same mid cap space. In addition, what you need to do, start a SIP in ICICI Prudential Blue Chip Fund for about 7,000 rupees, and Canara Robeco FlexiCap Fund in the FlexiCap space for about 3,000. This brings your total up to 20,000 a month, and at 12% annualized expected return, you'll reach your target in 15 years.
In case she wants to increase her investment amount, then that should be going in these funds itself.
Correct. So I've just named two additional funds, which is the
Right.
ICICI Prudential Blue Chip as well as the Canara Robeco Flexi, where she can put in the additional money.
All right, we move on. Amit, this question is for you. Samson has sent this query to us and he's investing in small cap, mid cap and sectoral funds since last 2 years. And in small cap, he has Nippon India Small Cap Fund, SBI Small Cap and HDFC Mid Cap Opportunity, SBI Magnum Mid Cap, Axis Mid Cap Fund. He's investing 20,000 in these funds, SIPs every month going. He wants to understand if these funds would help him accumulate almost 10 crores in 30 years.
Yeah. So to accumulate 10 crores in 30 years, Samson will need to do an SIP of about 22,000 rupees per month. I'm assuming the whole portfolio is going to grow at 14% on an average annualized. That should help him achieve his target. He is investing about 20,000, so I don't think additional 2,000 is going to be a problem because in the coming years he might be able to invest more, maybe more than 22, so the averaging will happen. In terms of schemes that he has shared with us, out of 5, I would recommend retain the 4 because I'm a believer of not churning too often. So one of the scheme has not been a good performer in my opinion. So the ones that he should retain I'm going to call out those names: SBI Magnum mid cap, HDFC mid cap, let him continue. Nippon small cap, let him continue. SBI small cap, let him continue. If he continues in his investments in these four schemes, that should be fine. He must watch out for a couple of things. Of course, direct plans, and of course, he has to assess the cost of managing his money. Two things I want the investors to watch out for. One, during the bear market, how much was the fall of his portfolio in a particular scheme that he has in his portfolio with respect to the index? You know, that's number one. Number two, how fast the scheme recovered. So how resilient the scheme is. So resilience of the scheme in terms of performance from the bear cycle to the bull cycle, how fast that happens, that reflects a strong perspective about how the fund is being managed, how the fund house is giving emphasis on changing trends in the industry, in the markets, and how they care seriously about investors' money in making sure that the money, the returns are bouncing back once the markets are turning around. So that's my view to Samson about his investments.
All right, next question is from Devika, and Gautam, this is for you. And she says that she wants to start investing in mutual fund, and she wants to accumulate 5 crore plus for retirement, which is almost 25 years away, and she can invest 10 to 15,000 per month right now.
So fantastic, because she's starting early, she'll be able to achieve her target with investing this 15,000. So at 15,000 SIP per month, growing at 12% per annum, will help her achieve her target in 25 years. So she can achieve 5 crores. I'll just list out the funds that she should consider investing in. ICICI Prudential Blue Chip Fund, she can start a SIP of 4,500. Kotak Equity Opportunities Fund, a SIP of 2,000. Mirae Asset Mid Cap Fund, a SIP of 2,000. SBI Small Cap Fund, a SIP of 2,000. Canada Robeco Flexi Cap Fund, a SIP of 4,500. So that totals to 15,000. So idea is to continue in the SIPs and just keep reviewing the funds and making sure that you stay invested in the funds that are being well managed and are selected by your advisor or distributor.
All right. Next query is from Sameer, and he wants to know good time to invest in technology funds like Tata Digital India or ICICI Pru Technology Fund. Now, tech companies have been on the losing side this year, and stocks are yet to recover from their 2020 or 21 highs. He's a long-term investor and wants to understand if if he stays put in these technology funds, what kind of benefits would he get in terms of accumulating a corpus? Which sectoral fund also on the other side would be good for a long-term horizon? Amit.
Kavita, this is a very good question. I would like to answer it, and please pause me immediately if I cross your time limit, because I may go overboard with this. Okay. Technology sector has had a lot of volatility lately. After COVID, during the lockdown, and immediately after the lockdown, the tech sector was the fastest sector that went back up, because everybody believed technology is going to change the world. Work from home has happened. People are now doing a lot of tech-based stuff, and their lives are running smoothly because of the COVID. And the lockdown was a big learning lesson. So tech companies did really well. What ended up happening is they overshot the valuation. The companies didn't have that much value in it as the stocks were projecting. So some normalization was supposed to happen, but the triggers that burst the bubble was the war back in March, the inflation, and the fears of recession. So now normalization is happening. The stock values are getting normalized. So it's a sectoral investment. Sectoral investment has its own risks and rewards. Biggest red flag for sectoral investment is that the investor return is bad. The investment returns is better, because people jump in when the sector indices have peaked, and then when the sector indices start to correct, people kind of exit the investment. So investor return needs to be looked at here. Other things, whether should we invest in technology companies in India? I don't think so. All our top performing funds have top performing IT companies. You look at the fund, every fund most likely has Infosys, HCL, TCS, Wipro, right? And our India-based tech companies are service oriented, are project solution based companies. I would suggest invest in technology or a tech sector, but in the companies which are product based. So look at the overseas like Apple, Google, Amazon. They have different nature than the services that we render. So invest in these companies through Nasdaq 100. You still have some mutual fund schemes where they are investing for investors in Nasdaq 100. Explore them. I think it's a wonderful opportunity for us to invest there and hang in there for a long term because it's a sectoral
Right.
exposure in your portfolio.
Right. Okay. So, Sameer, that's the recommendation for you. And with that, I think it's time up for the show today. Thank you so much, Gautam and Amit, for being on the show and helping our viewers plan their finances. And before we wrap up, we'll give you a WhatsApp number and an email ID where you need to send us your query so that we can help you plan your finances and your financial portfolio with our experts. That's the number and the email ID. Thank you so much for watching. Goodbye.